How to read an income statement like a Wall Street analyst. Most people have no idea that Apple made $383 billion last year. But here's what they're missing. The company spent $313 billion just to make those products. That's the difference between what sounds impressive and what actually matters. And if you're investing money in your Roth IRA, your 401k, or even just throwing cash at stocks on Robinhood, you need to understand this document. Because income statements don't lie. They tell you exactly how profitable a company really is. And right now, most investors are reading them completely wrong. Hey, I'm going to walk you through an income statement exactly how Wall Street analysts do it. By the end of this, you're going to look at any company's finances and immediately know if it's actually making money or just pretending. Part 1, the top line. Where the money comes from. Let's start at the very top. This is called revenue or sales. Same thing. This is the total money a company brought in from selling products or services. No exceptions. No asterisks. For a company like Microsoft, revenue in 2023 was $198 billion. Sounds insane, right? But here's what matters. Where did that come from? Microsoft makes money three ways. Selling software subscriptions through Microsoft 365, renting cloud computing space through Azure, and their gaming division. This breakdown matters because if one revenue stream disappears, you need to know how bad it hurts. This is why Wall Street analysts obsess over revenue growth. If a company grew revenue 10% year over year, that's healthy growth. If it grew 50%, that's a growth stock. If it declined, that's a red flag. When you're deciding whether to add a company to your S&P 500 index fund or pick individual stocks on Fidelity, the first number you check is always revenue growth. But here's where most people stop. And that's where they get hurt. Part 2, the invisible bloodsuckers. Operating expenses. Because now we need to see what actually got spent to make that revenue happen. This is called operating expenses. And this is where the real story lives. Let's say a company has $100 million in revenue. Congrats. But then you see they spent $45 million on cost of goods sold. That's the direct cost of making their products. Then they spent $30 million on research and development. Then marketing. Then salaries. Then rent. Then suddenly that $100 million in revenue starts looking a lot smaller. This is gross profit. Revenue minus cost of goods sold. That number tells you how efficient the company is at actually producing stuff. Amazon's gross profit margin is around 47%. That means they keep 47 cents of every dollar after paying for inventory and shipping. That's actually healthy for retail. But then you subtract operating expenses from gross profit, and you get something called operating income. This is the money a company actually made from running its business. No accounting tricks. No one-time events. Just pure operating performance. If operating income is declining while revenue is growing, something is wrong. The company is spending more to make the same amount of sales. That's a death sentence long term. This is the number that separates real profitable companies from companies that are just burning through investor cash. Part 3, net income. The actual bottom line. Finally, we get to net income. This is what's left after you subtract literally everything. Operating expenses, interest on debt, taxes, everything. Let's use Tesla as an example. They reported $25 billion in revenue one year, but net income was only $13 billion. So basically, after everything, they kept about half their revenue as profit. That's exceptional. But here's what most people miss. Sometimes a company will have terrible operating income but a huge net income because they sold off some property or had some one-time gain. That's not real profit. That's a trick. Wall Street analysts call this quality of earnings. They want to see profits coming from actually running the business, not from financial engineering. So when you're analyzing a company, whether it's for your Roth IRA, your 401k, or just because you're curious, don't just look at net income. Look at operating income. Look at the trend. Is it improving, growing, or is it getting squeezed? The call to action. Income statements are the foundation of everything. Buffett reads them. Analysts read them. And now you know how to read them too. Start looking at income statements for companies you own stock in. You'll immediately see things other investors miss. And that edge, that small edge, is what builds wealth over time. If you found this helpful, subscribe. I'm dropping financial analysis like this every single week. And hit that notification bell so you never miss when Wall Street tricks get exposed. Your future self will thank you. Word count 847.